Principles of Accounting, Chapter 20. In Chapter 20, we talk about cost volume profit analysis, also called CVP analysis. So this analysis looks at how costs and profits act in response to changes in the level of business activity. So how do our costs and the amount of profit that we make from an item change based on volume sold or volume produced. So this helps us make better decision making and to also construct budgets for our future operations. When we're looking at CVP analysis, we do something called what if analysis or sensitivity analysis along with the CVP analysis. And that helps us answer these questions and many more. What level of sales do we have to make in order to cover all of our expenses? How many units of a product must we sell in order to meet a specific operating income or net income? What happens if we expand capacity? What happens if we do a big sale and reduce the amount of money we're bringing in on a product? What happens if we increase spending on advertising? Does that increase sales? And can we maintain that level of production if we do increase sales? And even more questions. So we're going to talk about this airline industry. So we have this McKinley Airlines. They're a small charter-based service in Fairbanks, Alaska. Assume their average monthly cost of operating the airline is $66,000. So we're looking at passenger miles as an activity base, and we want to look at the airline's cost as fixed cost, variable cost, and semi-variable cost. So we've already talked about fixed cost and variable cost in Chapter 16 when we were doing cost classifications. So fixed costs stay the same over the relevant range or a period of time. They tend to be things that we're locked into with a contract, like salaries and rent. Variable costs vary directly with the number of units that we make. Those tend to be more direct costs. We can have indirect variable costs though. And semi-variable costs are also called mixed costs. These are costs that have both a component of fixed costs and a component of variable costs. So when we're looking at fixed costs, these are the ones that don't change in response to volume. So whether we make 10 units or 10,000 units, our monthly depreciation, our monthly rent, most of our insurance policies, our salaries and stuff don't change based on production. With variable costs follow a linear relationship in how much we change. So if this is where we get into like the direct materials when we talked about bikes in Chapter 16. If we make one bike, we need 2 tires. If we make 2 bikes, we need 4 tires. So that is how a variable cost relationship works. As we increase volume, we increase our costs linearly. And then our mixed costs contain both components. So often utilities are a semi-variable cost. We also have here, we have a monthly fee. They have a fixed base rate and an added charge for each passenger mile flown. So this is actually very common when we lease or rent our space, that we pay a per square foot amount. And then we also pay a percentage of sales or a percentage of customers. Okay, so we have all of this information about our company. We have fixed costs of $11,000 per month, or insurance $11,000 per month, depreciation $8,000 per month, and salaries of $20,000 per month. Our variable cost is 8 cents per passenger mile for fuel and maintenance. And then our semi-variable costs or mixed costs, We have airport usage fees. We pay $3,000 per month, and then we pay 2 cents per passenger mile. So what do we do with all of that information? Well, what you see here is called a CVP analysis graph. So we make graphs of our costs. Our fixed costs are almost always a straight line, straight across. So our fixed costs are $39,000. Then we have the mixed costs that contain a fixed component and a variable component. And then our variable costs, which increase in a straight line at an angle, the slope of which is the total variable cost. So now when we get into this chapter, we get into a lot of linear algebra. If you remember the equation of a line, y equals mx plus b. Well, y is total cost, b is fixed cost, and m is our variable cost, and x is the number of units. So when we're trying to look at what is our average cost per passenger mile, so we've looked at 3 different levels of passenger miles. We have 200,000 miles, 300,000 miles, and 400,000 miles. As we increase the number of miles, our fixed cost per mile goes down. So we have that our total cost per passenger mile decreases. So if we only fly 200,000 miles a year, then our cost per passenger mile is 31 cents. But if we can increase our flights to 400,000 miles a year, we can decrease that cost to 20.5 cents per mile. That's strictly from making changes in the volume of work that we do. So then when we're looking at this, we have the average fixed cost per unit and the average total cost per unit. So at 200,000 passenger miles, our fixed cost is 21 cents per mile, and our total cost is 31 cents per mile. That gives us an average variable cost of 10 cents per mile between these two. As we increase our volume, our fixed cost per unit will decrease. So our variable per unit cost stays the same with increases and decreases in volume. The per unit fixed cost decreases as volume goes up and increases as volume goes down. Total fixed costs stay the same regardless of the number of units, and variable costs will increase if total costs will increase if our volume increases, and the total cost will decrease if the volume decreases. We also have the opportunity to create economies of scale. So economies of scale refer to our ability to reduce total unit cost just by using the company's productive assets more efficiently. So this is increasing our level of production. So here we're looking at an automobile plant that has fixed costs of $8.4 million per month. They have the total capacity to produce 7,000 automobiles per month. So if they produce 7,000 cars per month, the fixed cost per unit drops to $1,200 per unit. Now, just because we have the capacity to produce 7,000 automobiles doesn't mean that we should. We also have to think about how many can we sell. We don't want to have a lot of stagnant inventory that is going to cost us money. So economies of scale is most commonly achievable in businesses with really high fixed costs. Some examples of those are airlines, oil refineries, steel mills, utility companies. So most very large companies have some sort of economy of scale. It's difficult for a smaller company to compete with that just by sheer volume. that creates that economy of scale. Smaller companies can realize their own by using their facilities as efficiently as humanly possible.